Hello. The word agility featured on the cover of all of the Keppel Group of Companies' annual reports for 2014, and so it is too with Keppel Real Estate Investment Trust, which owns office buildings in Singapore and Australia. And agile is what Keppel REIT has to be because, as they say on page 9, 2015 is expected to be a challenging year, and that's how it's already turned out. But the annual report isn't just useful to hear about Keppel REIT's performance, but also to hear more about the market. For example, they talk about the number of financial services companies that are moving some of their offices out of the central business district, and in their place we're seeing a lot of TMT, telecommunications, media and technology companies moving into the CBD, among them LinkedIn, Twitter and Booking.com. More about the market in just a few moments and some of the colour, but first let's get you up to speed on what buildings Keppel REIT actually owns as at the time of the annual report. Here it is. You can turn to page 11 to see for yourself, and you can see that they have 12 office towers in Singapore, Sydney, Melbourne, Brisbane and Perth. In Singapore, they own the Bugis Junction Towers. They also own 1/3 interests in Marina Bay Financial Centre and One Raffles Quay, and they own almost all of Ocean Financial Centre, which is a very important earner for them. In Australia, they are represented in, as I mentioned, a couple of cities. They own all of 77 King Street, which is on the corner of the main street in Sydney, of George Street. You'll recognise it by the big Apple logo out the front. They also own stakes in 8 Chifley Square, 8 Exhibition Street in Melbourne, 275 George Street in Brisbane, and they own a 50% interest in a building which is currently being developed in Perth. In fact, in mid-March, they had a topping out ceremony of the old Treasury site, Treasury building that's currently being redeveloped. Let's now turn our attention, though, to some of those other comments about the market that Keppel REIT is operating in. And you can see from this chart here, page 27, I think this is, where you can see the island-wide supply, demand and occupancy of office space. So the supply is in grey, the demand is in orange, and the occupancy is in blue. And you can see that there's an ever so slightly downward trend in the occupancy rate to less than 90% as at the time of the annual report. There's also some other interesting charts to show around that space where we see new supply and new demand and vacancy rates coming up. So we're now talking about new buildings, and you can see that there has been a mismatch in past years, and vacancy rate is creeping up to now above 10%. So for Keppel REIT, obviously what's important is that demand outpaces supply, that there's an ever-increasing number of tenants who want to take up new space, or space at all in Keppel REIT's buildings. And so what we're seeing at the moment is that things are just a bit soft. And when you look at the years ahead, there's also this chart, which I find particularly interesting because it goes to show where some of the new supply is coming into. And you can see the big bar of more than 4 million square feet in 2017, about half of that in the Raffles Place, Shenton Way area. And no surprise, because we've got buildings like the South Beach Tower, the Guoco Tower in Tanjong Pagar, and V on Shenton, among others, coming on stream next year, as well as the Duo Tower in the time after that. So you can see a big spike in supply coming up, and that's obviously why agility is particularly important if you're in the office space business at the moment. Now let's turn our attention to some of these other charts which show exactly where Keppel REIT is at in terms of its own leasing picture, where things are at in terms of its own occupancy rates. And this chart over here shows you the portfolio lease expiry by monthly gross rent. In other words, how much of their rent, the tenants who pay that rent, are going to see their leases expire. And you can see the biggest bar is in 2020 and beyond, about 1/6 of tenants swapping out in 2016, 2017 and 2019. But obviously Keppel REIT would point to that to suggest that they're going to maintain their rent even as we see new office space come on stream. Those tenants who are paying for this much of their rental income at the moment is a relatively small proportion. I guess that's the point. We also see on this chart here the portfolio occupancy by committed net lettable area, and you can see we're almost at 100% for all of them, with the exception of 77 King Street, but that's at 92.5%, so also still quite substantially taken up. So far the picture that you would be getting is that we're getting an increasing number of office space, particularly in Singapore, coming on stream. The number of tenants who are seeing their leases expire over those coming years when that extra supply is coming on stream is relatively small, and at the same time we're seeing a little bit of softness in terms of occupancy rates, depending on whether you're looking at new or existing buildings. So with all of that in mind, now let's take a look at the financials as Keppel REIT announced them in their annual report for 2014. You can see the big number there, 151 million in net property income, up almost 10% year on year. And two main reasons for that. First, Ocean Financial Centre had a better performance. It's a very important part of their earnings, as I mentioned. And 8 Exhibition Street in Melbourne contributed for the first time for the full year. Other bits and pieces from the annual report which lend some extra colour to that. First, the rental reversions were up 17%. New offices attracted rents of 23% more than the previous year, and we also saw 85%, 8 out of 10 of office tenants stay in their buildings. Also, the weighted average lease to expiry is interesting because it shows that the top 10 tenants have a WALE, as it's called, of 9 years. So once again, quite a long time before those top 10 tenants will be up for renewal. The overall portfolio WALE is at 6 years. Now let's take a look at the share of results of associates. 60.7 million, that was down 2.2%. This contribution is helped now by the 1/3 interest in Marina Bay Financial Centre and One Raffles Quay. Distributable income, 206 million is the number, which is down almost 4%, even though the share of joint ventures was up by almost to $10 million. Partly because Prudential Tower, that 16-year-old tower, was sold, and they only had a 2-week contribution from Tower 3 of Marina Bay Financial Centre, which they brought into the fold. The dividend per unit, by the way, was down by 8.2% at 7.23 cents. Now this is interesting because in the previous year, 2013, they reported 1.97 cents every quarter. 4 quarters, 1.97, so almost 2 cents per unit. In the year under review, 2014, they had a 1.97 cent distribution in the first quarter, but that then fell to 1.9, 1.85 and 1.51 cents. So you can see that as 2014 moved on, they were paying, every quarter they were paying less than the previous quarter. Since then, here into 2015, and they've paid 1.7 and 1.72 cents. So certainly an improvement on the 1.5 cents that they paid in the fourth quarter of last year. But at the same time, we're not back at that 1.97 magical figure that we had throughout 2013. Assets under management was up 14% because they added Marina Bay Financial Centre Tower 3, as well as the upward revision of capital values of certain properties. And it's interesting too that the amount of space that they have in Singapore is about 79% of their total area, but the value of the space in Singapore is actually 88%. So 79% of their area, but it makes up 88% of the value of the REIT. So that's a quick look at the financials. Let's dig a little bit deeper into other parts of the annual report. For example, the debt maturity profile you'll find here on page 66. And what you'll see here is that they do have some debt due in 2019. That's probably the longest bar there. Aggregate leverage is up at 43.3%, up from just over 42%. 45% is the ceiling. Interest coverage ratio 5 times, down from 5.5 times. And interest rates, the aggregate rate is 2.23, up from 2.15. Once again, take a look at page 66 if you want to take a look at that for yourself. Also of interest is this page here, page 155, where we look at the bank balances. And you can see what's particularly interesting is the big jump in bank balances. To some extent, that is exacerbated by the rental support that they've received and hold in separate accounts, but still a very sizable increase and almost doubling of their cash balances compared to a year earlier. And here we are now on page 80, and what this shows you is the remuneration. What's noteworthy about this is first that the top executives, in bands there of 250,000, about half of their pay actually comes in the form of variable or performance-based bonuses. And the second thing that's really interesting is that their remuneration of the directors and employees are actually paid by the manager and not by Keppel REIT. So Keppel REIT has put it in its annual report, but it's actually the manager that pays for those salaries. So there's a review for you of the Keppel REIT Annual Report 2014.